Hi, this is Dale again. I'm going to talk about how to invest in today's rising interest rate environment. First of all, I'm not an investment advisor. I've been investing in the stock market since the Dow was below 1,000, and it stayed there for maybe 15 years before it got to 1,000. So I've been doing this a long time. I've had some successes and some not so successes, but I want to briefly discuss four different approaches for the conservative investor to invest using these different techniques. I invest with an online broker and I make all my own decisions. Some are good, some not so good. The first approach is a CD or treasury ladder, and I'll go into the detail in a minute. Second approach is floating rate bond funds. The third approach is ultra short bond funds or exchange traded bond funds. And the fourth approach is investing in funds, exchange traded funds that invest in companies that are likely to do well when the interest rates go up, which is what's happening now. This is 2018 in the middle of the summer. So let's get started. With short-term CDs or treasury bonds, you're guaranteed that you'll get your money back at the end of the term. In a bond fund, maybe you will, maybe you won't. So what I do is invest in, at this point in time, in anywhere from 3-month to 2-year CDs so that I have money coming mature so that I can reinvest that money at a hopefully higher interest rate. So that's a very conservative approach. It's called a ladder. Even some financial advisors these days are recommending ladders. The next approach is floating bond funds. The one I'm familiar with is an iShare called FLOT is the symbol, and it tends to invest in company bonds, debentures, whatever you want to call them, that will float up and down with the current short-term interest rates. So that's a second approach that you might take. The third approach is ultra short-term bond funds. Now there are multiple of those out there. I happen to invest in a PIMCO fund called MINT. When I started investing in it maybe 2 years ago, and it was an alternative to money market funds paying around 1%. Now that short-term rates are going up, it's paying close to 2.5%, and that will only increase. So that's a relatively safe way to invest some of your money. There are other ultra short-term bond funds. I'll mention Invesco Fund, GSY is the symbol. The SPDR Ultra Short-Term Bond Fund, ULST. The iShares Short Maturity Bond Fund, NEAR. The iShares Short Treasury Bond, ETF, SHV. The SPDR Barclay 1 to 3 month T-bill, symbol BIL. Now the fourth and last one that I wanted to briefly talk about is investing in stock funds, where the fund invests typically in companies that do well when the rates go up. I've been investing for a while in the Fidelity Rising Rate Fund, symbol FDRR, and it tends to go up and down with the market, but at least in theory, it will do well as the interest rates go up. It's tied to the Fidelity Index for rising rate stocks. So those are four different approaches to deal with the interest rates going up. The Fed has control over the short-term interest rates, but the bond market has control over the longer term interest rates. So it's good to be aware of the situation that we're in and try to protect your monies. A fifth approach that I use on an ongoing basis, which I'll just briefly mention, a topic for another video, is precious metals. Metals tend to do well. They've been around for a couple thousand years at least, whereas fiat currencies like we have last for so many years, and then they create a new set of fiat currencies, like the new currencies in Europe or whatever. So having a small amount of money invested in gold and silver coins, physical gold and silver coins, in my opinion, is a good hedge against the possible issues with fiat currency that eventually will happen, maybe not in my lifetime or your lifetime, but within the next 100 or 200 years, the fiat currencies will change, if not sooner. So thank you for watching. I hope to put out more videos in the future concerning investing for retirement or people that are in retirement. Thank you very much. Bye.